They've certainly come down over the last decade in Canada as a result. So higher the tax rate, the less investment in the country because the fewer projects have an after-tax rate of return worth the investment. Depreciation regulations. Well, again, depreciation is accounting for the loss of value of an asset. Since it adds value in the sense that it reduces taxes, if we have projects that have favorable treatment, it means you can take all of the tax savings early on in the project. Well, that adds value. So we'll see how the government influences, let's say, whether we make an investment in satellite equipment or terrestrial communication equipment. What will be a function of how favorably the tax regulations, let's say, favor the satellite versus terrestrial. And that will affect our after-tax return. And finally, tax credit programs. Government looks at, again, trying to, equalize the wealth that is Canada across the country. And so if we look at an engineering project, we want to locate in Central Ontario. Well, it could very well be that locating way out in Cape Breton Island in Nova Scotia has all sorts of wonderful tax credits associated with it. Normally, we wouldn't even consider going out there, but we do an after-tax return of locating there, and perhaps it's worthwhile. And again, we don't care as a company where the value comes from, the taxpayer or our customers. We're looking at after-tax value. So all of these factors, and we'll talk about the specifics of the regulations and how we factor them into our cash flows over the next few lectures. These are the things that affect our engineering projects. Now, of course, no one likes to pay tax. But we see it as sort of a necessary evil to fund all of the services and programs, and wealth equalization, if you will, across the country. And before we talk about the actual details, I'd like to just talk a little bit about, well, what's desirable in a tax system? Well, not having one is the most desirable aspect, but given that we have to, what do we want? Well, first point I should make is, income tax in Canada was a temporary measure. The government promised to get rid of it sometime shortly after 1917. It needed to fund World War I. It didn't have the revenue, so they said, well, let's try income tax. And they did, and they said, temporary measure just to pay for the war. But of course, they got hooked on that revenue, and as you know, they've been working on it ever since. I mean, that 2,000-page book, divide that by about 100 years, and they've been sort of writing 20 pages of tax regulation a year ever since then. It's too good a revenue stream to give up. So, of course, it's not temporary anymore. The government lied to us back in 1917. What do we want about an income tax system? Well, an income tax system works if people think that it's, they begrudgingly pay their taxes, but they have a sense that, it's necessary evil. So our system is based on what we call self-compliance. In other words, we pay our taxes because they're sort of reasonable and we think it's fair and whatever. Also, there's a fear of getting caught and the penalties are quite stringent. But if we want to enhance this self-compliance where people are voluntarily saying, this is how much I made, this is how much tax I need to pay, and I'm going to pay the tax, what do we want in a system? Well, to encourage that sort of self-compliance, people want it to be fair and equal. What does that mean? Well, if I'm making a certain amount of income and someone else is very much like me, perhaps we should both be paying the same amount of tax. In that case, okay, that person's paying and I'm paying it. But we have this notion in Canada that, we want sort of, the more wealthy to pay more tax. And so we have what's a progressive tax system, which essentially means that if you have the ability to pay, you're going to pay. And the more your ability to pay, the more you're going to pay. And we call that progressive. And so as we'll see, the way it's set up, the more money that you make, the larger the tax bracket. And conversely, if you're not so well off, perhaps you shouldn't pay as much tax. Indeed, that's the way the system works. Indeed, if you're below a certain threshold, there's social support. So it's a negative tax. It's a credit to help maintain a certain level of standard of living across the country for everyone. And so progressive tax systems make that happen. Because essentially someone's got to pay more than average if people are paying below average. That's how it works. Now, what does it mean to be fair and equal? Well, it depends on where you are in the political spectrum. Right? If you're well onto the right, you're going to say, well, tax rates should be really low because we want to encourage investment. Investment creates employment. Employment creates wealth and well-being for the citizens. Okay? Therefore, tax rates should be very low. And, let just business get on with business. Of course, if you're on the left, you're saying profits are far too high in the corporate world. There's far too uneven a wealth distribution in this country, and the tax mechanism is one way to transfer wealth and level that income. So tax rate should be really, really high, and government should take key active interest in reallocating wealth. And where we actually are, I guess, is a function of the political party in power and the folks that voted those folks into power. Okay. We want it to be efficient. We don't want an army of Revenue Canada folks forcing people to pay tax and throwing them in jail because they're not complying and having an army of auditors. And of course, it's efficient if people comply voluntarily. And I think our system, by and large, most people pay their taxes. Okay. Efficiency has certainly been enhanced over the last decade or so with information technology. Virtually everything that we make is recorded in a computer somewhere. The taxes we pay recorded somewhere, and computers are very good at spitting out reports and basically alerting auditors to anomalies. And then, of course, they look at anomalies like all of a sudden, you're making $10,000 worth of interest in the bank where you weren't before. Well, that means you probably have gotten $200,000 somehow or other. Where did they come from? Did you pay taxes on it? So those are sorts of reports that get kicked out that trigger audits. Revenue Canada's gotten very, very good at that. We want it to be neutral. If you're an economist, you want to say, well, we want companies and people to do what makes sense economically. We don't want that distorted by, this artificial, if you go out to Cape Breton Island, you're going to get tons of tax dollars. We normally do that in the absence of tax incentives. So economists and many folks say it should be neutral. People should do what they should do because it's economic, not just to save money. Okay. We want it to be certain and predictable. Well, it makes sense. And we want it to be simple. Okay. Now, what about the Canadian Tax Act? Does it meet any of these criteria? Well, fair and equal, depending on where you are in the political spectrum, the answer is yes or no. Okay. Is it efficient? I think it is. Largely, there is self-compliance and the use of information technology to basically put the fear of God in every taxpayer to make sure that they do pay their taxes is very helpful to creating efficiency of the system. Is it neutral? Absolutely not. It wouldn't be 2,000 pages thick if it were neutral. Those 2,000 pages are affecting economic decisions that would not necessarily be made in the absence of incentives. Certain and predictable? Well, I read you that passage on giving a gift. Is it simple? Is it predictable? Absolutely not. This is why we have a whole army of folks out there making very good careers out of understanding what's in the book and advising people on how to pay your taxes. Because again, ignorance of the law is no excuse for not paying your taxes. And so it's incumbent on the taxpayer to understand his or her obligation under the Act, and oftentimes you have to pay for that privilege of understanding. Okay, that's just the way it is. Okay. So essentially we want a system that people think is fair and equal, and we want self-compliance to basically minimize the cost of collecting the money. As well, we want to minimize the underground economy, because if you're evading taxes, there's all sorts of cash outside the system that's not being reported, and everyone works in cash. Undesirable from a tax point of view. Okay. Well, what are you up against once you get out of here in terms of paying taxes? I want to give you a sense of what sort of tax rates, and hopefully you can see this, that there are in Canada right now. And to give you a sense that taxes have come down over the last decade, largely as a result of North American free trade, where we have to more align ourselves with the folks in the United States. And I'll give you a sense of what sort of taxes you will be paying if you decide on an engineering career in the United States as opposed to Canada. We'll give you a sense of where things are. First thing I want to say is that there's three types of income as far as the income tax is concerned. If you work for a living, it's called ordinary income. That is taxed at the highest rate. Equally well, if you earn interest on a bond or a bank account, that is ordinary income as well, taxed at the highest rate. And what I'm showing here are the rates, and we call this the top marginal rate. Okay, and so I've gone through by each province, 10 years ago, just recently, what sort of the rates are. Okay, and the other types of income are capital gains. If I make money in the stock market, or I start up a business and I sell it 10 years later for a profit, let's just say it's taxed much less harshly. Essentially half of the working for a living rate. Well, why? Well, government believes that they should incentivize folks in terms of taking a risk and investing. because investing in companies generates employment, generates wealth. So if I put my money in the bank, I'm going to pay 46% tax. If I invest in a company and I make money, well, I've created employment and wealth. I'm rewarded by only being taxed half that rate. Similarly, if I make my money through investing in Canadian companies and receive dividends, remember when we talked about accounting, you were taxed twice, right? The company was taxed on the profit it made, and when I got my dividends, I got taxed again. Well, that's not really fair. And so if I receive dividends from a Canadian company, there's a credit, so effectively I pay less. So the way to look at it is, if I make ordinary income, if I work for a living, or I get interest, at the top rate, half goes to taxes. If I make my money in the stock market, a quarter goes to taxes. If I receive dividends from Canadian companies, a third goes to taxes. Okay? And this then will, I guess, affect the mix of investments that I want to make in terms of after-tax return. Now, in terms of why these numbers are different across the country, income tax basically is the domain of two levels of government, the federal government and the provincial government. The city governments don't level income tax, it's property tax. That's the law. And so the federal government basically drives the whole system with their set of laws, and that's the book that we talked about. And the provinces generally piggyback. So it's a percentage of the federal tax that you pay to your provincial government, and then there's some changes, some minor variations by province. So I should say, as you go across the country, perhaps the best place to be in terms of taxation, I'm not sure if I want to live there, I'm going from Alberta here, hopefully, is in Alberta, where the top rate is 39%. A very wealthy province due to its oil resources, and the government there shares those resources with the people of Alberta by not charging as much provincial tax. Perhaps the worst place to be, number one, is Nova Scotia, Cape Breton Island I keep referring to, 48% tax. Okay. We're somewhere in between at 46%. Taxes have come down over the last decade. If you had the misfortune a decade or so of living in British Columbia, the top rate was 54%. So work $1,000 overtime, the government takes $540, or used to take $540. Ontario wasn't much better off, we were 53%. Okay, so it's come down almost 10%. Okay. Now, these top rates, and we'll show you how these things actually work over the next few slides, just to give you a sense of how this all works, is if you're making more than $126,000 a year. Anything above 126 gets taxed at the top rate. And we'll talk about what happens below that in a little while. So that's the personal side of things. So that's what you'll expect to pay once you get out of here, or what you're paying already on your summer income. If you're a corporation, it's generally a flat rate based on what we're going to determine in Chapter 5, the taxable income. Again, governments like to implement policy, and they favor small businesses, because small businesses generate an awful lot of employment in the economy, and they're fairly risky. So small businesses get preferential tax treatment around 20%, and a normal business, a larger business, pays 33%. So what we'll do in this Chapter 5 is, what's the taxable income? If you're a small business, 20% goes to the government. If you're a normal corporation, larger, 33%. Okay. And it's revenue minus deductions equals taxable income. That rate times that taxable income is the tax. Okay. And then the taxable income each year is affected by the regulations we're going to talk about. Okay. So that's a sense of where we stand right now. Rates have come down, and there's provinces that are high tax zones and provinces that are low tax zones. Okay. Now, let's talk about how it actually works as far as an individual is concerned. And the key thing here, and the hard thing perhaps to understand initially, is this notion of average versus marginal. And the marginal often comes up in our courses as being very, very useful in terms of making decisions. And so let me first start with explaining what happens in terms of, let's say, a professional income. Let's say you're making about 80 grand a year. Okay, so 79 cents. First observation is, by simply being a living, breathing Canadian, you get about $10,000 deduction. Okay. So fill out your tax form, you make $80,000, you get to deduct $10,000, and so your taxable income is $70,000. So you don't pay tax on the first $10,000. Now, Ontario says if you're making that much money, you owe us $5,200, provincial government, so that goes over to Queen's Park, and Ottawa says you owe us almost $11,000. We'll show how that calculated a little later. So our total tax burden
16,000, which means on an average, if I'm making almost 80,000 and I'm paying whatever, 20,000 in tax, I'm paying around 20%. I can read that line, 20.1% on average. But think about what marginal means. Marginal means that if I make another dollar or $1,000 worth of overtime, I'm making that in that next bracket. And so if I'm here in this sort of $79,000 to $79,000 bracket, my marginal rate is 33%. So in other words, an extra dollar that I make, 33 cents goes to the government. Okay. And so the more that I make, the higher the tax bite. That's progressive taxation. So as I'm starting to make more and more money, I'm getting into the realm of making a really good salary, you see that the government takes a progressively larger bite of all my additional money. Okay. Up until the point where I get to 46%, which is Ontario, the top rate. Okay. And that kicks in at 126,000. So everything above 126 is taxed at 46%. Now you might say, well, here you've got negative tax. So if you're not doing so well financially, you pay a negative tax, i.e. you get a tax credit. Okay, and this is what I'm talking about in terms of sort of minimum sort of social equity across the country in terms of a minimum standard of living. So, you know, the folks are not making so much, you know, there's a tax credit system that helps as well. So we've got this notion of average, okay, and then margin. Now, if I'm talking about being an engineer and I'm looking at making investment decisions, then the investment decision is beyond my salary, right? Therefore, those decisions are influenced by the marginal rate. And we'll show you an example in a second. Okay, any questions? Okay. Well, U.S. versus Canada. Well, we all think taxes are cheaper in the United States. And of course, if we think that way, it must be so, and it is so. Let's talk about a good professional income. So I want you out of here, let's say you're making, you know, 100 grand or so. In Ontario, you're going to be paying 43 to 46% margin. Now, I'm not sure where I want to live in some of these states or not, but if you're in a low-tax jurisdiction in the United States, you know, you're working for Texas Instruments, you happen to be in Texas, you're talking 28%. An absolutely huge difference in terms of Ontario versus that particular state. There's a lot of states like that. Right? Of course, you have to worry about your own health care, covered here. But if you're a professional engineer working for a company, the company takes care of it. Yeah. So, and again, other states, you know, if you're out in California, well, 37. Still, significant difference in terms of what you pay in taxes. And of course, the decision there versus here is not just, you know, taxation, it's just one element of that decision. Okay. Interesting thing is, in Canada, we deem that you're a fat cat having to pay the maximum tax rate at a mere $126,000 a year. Whereas here, in the United States, I should say, you don't pay the top rate until you make $372,000. So, very different view of, you know, when you should be expected to pay the top rate. We're a far more progressive system in that the top rates kick in at a much lower rate, lower level of income than in the United States. But that's sort of flawed. So again, tax rates are lower in the United States. We'll talk a little bit about depreciation down there and how investment decisions, engineering decisions are different there versus here. Okay. Now, we just want to sort of illustrate this difference in terms of marginal versus average and how, this is personal income tax now, how it's calculated. Let's say you've got an income of around $92,000. So that's your taxable income. And again, the law requires you to declare all of your income from all of your sources and say, this is what I made last year. Now, let's just say, you know, when I was a student, Uncle Bob hired me at his cottage to fix up the place at $3,000 a month. Okay. And he gave me cash. And so I had, at the end of the summer, $9,000 worth of cash. What should I do? Should I write a little letter to Revenue Canada saying, Uncle Bob paid me $9,000, and here, I'll gladly give you 1,000 of that in tax? Or I never quite got around to writing that letter because I was busy studying. Well, what's the legal thing to do? The legal thing to do is you have to declare all of your income. That $9,000 in cash from your Uncle Bob is income, and you owe tax. Well, what would most people do? Oftentimes it's a function about whether you think you're going to get caught. Is there any record anywhere of Uncle Bob giving me that money? Well, maybe in his bank account somewhere, but what's the chance of the Revenue Canada finding that? There's no tax slip, there's no income, nothing. Now, I'm not going to tell you what most people would do or what I would do. However, the legal thing to do is, and it's tax evasion if you don't declare Uncle Bob's $9,000 income for payment to you. Okay? So a lot of it's driven about, am I going to get caught? And when we talk about gray areas, and I'm going to talk about gray areas, the issue is, am I going to get caught? And if I do, what's the consequence? If you're tax evading, and I'm a company and I don't declare $100,000 worth of income, I'm going to get crucified. Absolutely for sure. But if I just say that something is this when it really is this and it's sort of close, that's just a matter of opinion. And if I lose, generally I'll just have to pay the taxes and interest. Okay. When we talk about gray areas, especially in small business, we have all sorts of opportunities to play in. Okay. But anyway, let's just say you've declared $91,800 worth of income, and you get, and this is now a year or so old, everything goes up by inflation, so these numbers go up by inflation, but they haven't changed the laws very much, so this is how it works. So my taxable income around $81,000. That's, and now let's say if I'm a professional engineer, I'm going to have a $400 annual professional engineering fee. That's deductible as well. That reduces my taxable income. Now, the way it works is, think about my income in being in tiers, and each tier has a tax rate, and as I go up, the tier has a higher tax rate. So the first 35 grand is taxed at 21%. So on that first income, I pay $36,000. The next tier is between 36 and 40, 24%. So on that income between there, I pay 24. And I think you get the idea. As I move up through all of these tiers and the marginal rate increases, each tier gets progressively taxed higher or harsher. That's progressive tax. So add it all up, and I'm saddled with a $22,000 tax bill, which is really sort of the integral or the average, or however you want to express that, in terms of those progressively harsh tax rates, the more money I make. What's my average? Well, if I made $91,800 and I'm paying $22,000, I've got a 24% tax rate. Average. But from a marginal point of view, I'm in this bracket between 81 and 126 and 43%. So my marginal rate is 43. So if I work overtime or I have an investment decision to make, given that I'm making that money anyway, that's the relevant number. So let's talk about now, if I have an interest, let's say I've got a bond and I'm making $5,000 a year worth of interest. Well, interest is taxed at the top rate. Okay, so let me just step back. If I made $5,000 in the stock market, half of it's tax-free, 25%, or 21.5%. If I make it in dividends from a Canadian company, it's 33%. Yes, sir?
When you say marginal tax rate, is that the tax rate for the next bracket?
That's the tax rate for the bracket that you're in for the next dollar that you make. Okay? So the way to look at it is $91,800. If I make $91,801, so $1 at the margin, of that $1, the government will want 43.4 cents.
How do you get that number?
That's in the tax table. That's by law. Okay. So the actual tax rates are legislated by law. Okay. So the 21 through 43 and the 46 is just numbers that the government gives you saying these are the numbers. The number that I'm calculating, the 24, is just the result of all of that. Okay. So these are given in the Tax Act. This one's calculated.
So that marginal rate is up to the point we get to that.
In the next bracket, yeah. So very specifically, if I'm making between 81 and 126, I am in the 43% bracket. So any income is taxed in that bracket, 43. As soon as I hit, let's say, 127, I'm in the next bracket, and any income above 126,261 gets taxed at 46.4%, which is the top bracket. That would be your marginal rate. Okay. And for example, if I'm an arts and science student and I'm making $35,000 a year, then I'm in the 21% bracket. Sorry, I can't resist. I'm just surrounded by them at New College, and they make fun of engineers, so this is where I get that. I'm very careful what I say at New College. I want to keep my job. Sorry, please.
Is the U.S. tax the same as like when you make $35,000, you pay that amount?
Yes, it's a progressive system where, and I haven't illustrated that, but yeah, I'm just showing you the top marginal rates for my comparison. But yeah, it's exactly the same. Most Western economies are like that because they want the richer people to pay more. And the way you implement that is through a progressive scale like that. So this is progressive tax. Okay, so if I have $5,000 worth of interest, I'm not taking any risk. The government says, pay me 43% of that. And so at the margin, think about what's happening. I'm going from 91.8 to 96.8 in terms of in terms of gross income. And that's $5,000 in the tax bracket, 43.4%. And so I owe the government $2,100. So I get to keep $2,800, and I pay $2,200 in tax. What does that do to my average tax rate? Well, now part of my income is being taxed above the average that I had before, and their average should go up. So my average has indeed gone up to 25%, as opposed to 24% before, because I got $5,000 being taxed well above the average at 43%. Okay. My marginal tax rate stays at 43% because now I'm making 96.8, and I'm still within the 81 to 126 bracket. If I made enough money to, let's say, get me up to 127, then my marginal tax bracket would be the 46.4%. So again, what's the next dollar, what bracket? And again, that's progressive tax. Please.
The average tax rate that we calculate was based on our government or
That's correct. Yeah, it'll be a function of how many deductions you have. You know, if you're a professional engineer, you get that $400 fee. That's deductible. That'll reduce your average. Okay. And if you have absolutely no deductions, it's higher. Okay, so that's the way it works. Let's now talk about some of the specifics and how we're going to get around to figuring out what the after-tax return of our engineering project. And again, key difference, Chapter 4, Chapter 5 is depreciation. Okay. You know, and in Chapter 4, I keep saying this, and perhaps on a quiz that might be coming up, depreciation, remember, is not a cash flow. It's not relevant to a financial analysis. It's looking at cash flow before tax, because it is. In Chapter 5, it reduces our taxes. Taxes are a cash flow. Therefore, there is a benefit of depreciation. Okay. And I'll start off by just writing down an equation, which is the depreciation tax savings. In other words, how much tax am I saving as a result of buying a piece of equipment that gives me depreciation in a particular period K? It is simply the tax rate, so this is tax rate, times the depreciation charge for the year, where the method of depreciation and the Tax Act tells me what this number is. That's what we'll talk about. So, depreciation, tax savings. Okay. So, buy an asset, depreciate it, save tax. The more taxes I save, the more profitable my project. Okay. And so, this is really a summary of what we've talked about, I think, in terms of loss of value, replacement analysis, and all of that. Essentially, what the government says is that you pay taxes on your profit. And one of your costs in determining that profit is the loss of value of equipment, depreciation. And therefore, we can factor that in terms of tax savings. Now, in Canada, we call depreciation capital cost allowance. That's just a technical term for it. And essentially, the Tax Act says for certain types of equipment, there's a certain percentage that I'm allowed. Okay. It really is all about government policy, not market value. So the only time market value comes into play is when I buy the asset, that determines this D sub K for as long as I have the asset. If book value is significantly different than market value, it doesn't matter. Okay, so once I know I'm buying it, I know what it costs, that sets this number for life. Okay? And so we'll see how that works. So market values are important. It's government policy basically driving these numbers. And if government policy wants to encourage an asset, it's, as we see, it's going to be accelerated in terms of depreciation. Okay. So CCA just determined Canada. Well, how can we go about doing depreciation? Well, I should first of all say, the textbook has probably about 8 different depreciation methods. Virtually none of them are used anymore. I don't know why Professor Fenton didn't take them out when he revised the textbook. I should never take anything out of a textbook. You always want it to grow the number of pages so you can charge more. So I didn't take it out. So for our purposes, for testing purposes, first of all, straight line and declining balance, the only two that you're responsible for. Okay. Where declining balance really is modified by CCA. Just for sort of interest, I'm just talking about the United States as well, the modified accelerated cost recovery system. That'll help you with problem set 3. Okay. So that, you know, different jurisdictions do things different ways, but essentially it's the same. It's just details. Okay. Now, companies keep 2 sets of books, perfectly legal. The first one is for tax purposes. So calculate your books in terms of the taxes and all of the things you're allowed to do and minimize the tax. That's the Chapter 5 view. That's what we're going to talk about. The second view is the Chapter 9 view. I want to present to my shareholders a reasonable definition of profit according to generally accepted accounting principles. And so those books will be basically like we did in Chapter 9. Why a difference? Well, largely depreciation, and we'll show you an example of the two and what really we want to tell our shareholders. We want to tell our shareholders generally accepted accounting principle profit, but of course, we want to pay the minimum taxes this year, so those other books will take advantage of every single loophole in the Tax Act to minimize our tax. Give you 2 different numbers. Okay. Let's talk a little bit about how we might go about it now from a technical point of view, and I want to talk, I guess, about the 3 methods: straight line, declining balance, CCA, which uses declining balance, and then what they do in the States very briefly. What are the input parameters to this? Well, I'm going to buy an asset, and the asset includes the first cost. It is the first cost, which is the purchase price of the equipment plus acquisition expenses. So if I got to pay the electrician to wire it up, that's an acquisition cost, part of the cost basis with the first cost. What am I after? Well, I don't use T there, but T's for taxes. I'm after decent K. I'm going to be told how to calculate that for useful life. Then I want to perhaps know useful life. And again, economic life is what drives all of us. Salvage value. The book value, a lot like Chapter 9, is the undepreciated capital cost in a particular year. So, you know, start with the actual value. If I depreciated 3 years, what's left over? Well, first cost minus 3 years of depreciation. That's the book value. Okay. And then in Canada, this little p is capital cost allowance rate. So for computers, 30%. Whatever. Okay, we'll show you for information technology the various rates. Essentially, the longer the life of the asset, the lower the rate, the longer it takes you to depreciate. So let's talk about the first method, which we really covered in Chapter 9, and accountants love this in terms of depreciation for financial statements. Straight line. Loss of value, P minus S, divided by the number of years of the economic life, gives you a uniform annual depreciation charge. And of course, the book value at any time, well, if this is the initial cost and I've got T equals 3 years worth of depreciation, well, what's left over is, you know, P minus 3 times D, that's the book value. Okay. For reasons that will become apparent, hopefully, Revenue Canada doesn't allow this for depreciation for tax purposes, except if I have a piece of intangible property. Intangible means not tangible, so it's not a piece of equipment, but some, you know, thing like franchises, copyrights, and patents. They have value, but they're not tangible. So franchise, you know, I get to use the Tim Hortons name, that's the value, I need to pay for it. Well, I get to write that off over time. Straight line. Now let's talk a little bit about why Revenue Canada and the politicians don't like us using this and for tax purposes. And let's use a very specific example that I'll carry through for the different methods. I'm going to buy a network router. I'm going to put it into service, charge my customers, so it's a capital asset with a reasonable expectation to earn profit from. Equipment itself costs $9,500, and my electrician hooking it up and what have you cost me $1,000. Useful life, I should really say economic life there, 5 years. And the engineer estimates 5-year economic life, we get rid of it for $1,500 salary. So the first cost, 10.5. And the method, let me just write it down here. I'm going to want depreciation in any year. Well, it's first cost minus salary divided by year. Okay. And DTS then is simply going to be T times D, because D is the same each time. Okay. Now think about what I want to do. I want to maximize the tax savings. Okay, that's what I want to do. So if I'm perfectly honest and I'm doing things straight line like the Tax Act says, what am I going to do? I'm going to write $9,000 worth of value, loss of value, right? 10.5 minus 1,500 off over 5 years. Right? So I've got 10.5, I've got 1.5, and I've got 5, and that is, what is it? 1.8. Okay. Now, let's just, for the sake of argument, to make the numbers easy, say the tax rate's 50%. That's too high, but it's an easy number, only one I can do arithmetic. So 0.5 times 1,800 means DTS is 900. So the way to look at it is, if I buy this network router, I am going to, over the next 5 years, reduce my taxes that I would have otherwise paid, tax savings, by 900. That is the value, right? That helps pay for the equipment here. Okay. So let me get rid of that. So we can do a present value tax savings. Okay. Now, what's the game? The game is, of course, to increase the tax savings. Let's say I'm a less than honest project engineer, one that's willing to, a taxpayer that's willing to bend the rules. Is there anything I can do to this to increase the value of the tax savings? Well, I got this to work with. What can I do?
Shorten the life.
Shorten the life. What's a good number?
1.
1. Okay. Well, if I do this, what am I saying? I'm saying $9,000 depreciation next year, and half of that is $4,500. Everyone okay? So I'm basically saying that this is 9,000 divided by 1 gives me 9,000. 9,000 times 0.5 gives me 4,500. Tell me which one's more valuable.
First one, the second one.
First one or second? What's the present value of this? It's close to 4,000. Present value of this is a lot less. So this is preferred. Well, let's say I'm not as daring as the student here, and I'm going to say 2 years. I'm going to get caught with 1. Anything else I can do? Okay. Well, what about if I say, rather than worth 1,500, it's 0? Okay. Because it's an estimate 5 years from now. Who's to say? I say 0. Who's going to argue? What about if I'm really daring? I say, it's going to cost me $2,000 to get rid of. Salvage value is minus 2,000. Won't that help us? But I'm not that daring. Let's say 0. But see the game. I can basically, through creativity and being less than honest, manipulate this to be worth an awful lot more in terms of tax savings. So if I go back to not being daring and saying 1 year, I can quite easily say perhaps I'm going to depreciate over 2 years, and it's a huge number compared to over 5. Therefore, Revenue Canada says, absolutely not. If you have to rely on a taxpayer to make some judgment and be honest, you can absolutely not rely on that taxpayer. Therefore, we don't do things this way for that reason. Okay, now, how do we do it? Ask yourself a couple of questions. What games can we play? Have the politicians in Revenue Canada eliminated all the game playing? And is there a game that I can still play with? Well, where does the game come in? The game comes in here and here. So you want a method that doesn't need salvage value or an economic life estimate. So what Revenue Canada, the Canadian Tax Act, uses, now they're very, very specific there. Canadian capital cost allowance is a set of rules that uses the declining balance method for the calculation. So that's the difference. So this is just simply a method of calculation which is used by the CCA, which is the set of rules that we'll show. And I got a bunch of formulas here, but too complicated. Let's just have a look at what happens. On this network router, I've got 10,500. It's called electronic data processing equipment. That's what computing equipment used to be called 25 years ago, and they never changed it. So it's a piece of EDC equipment, 30%. So 30% a year is my little piece, which means take 30% of the initial investment for the first year. That's your depreciation charge. Book value is 10.5 minus 31.50. Got that left over, another 30%. I think you get the idea. Now all of a sudden, I don't need economic life, not a function of it. I don't need salvage value, not a function of it. Those two games automatically go away with this this determinism. Okay. The only game that I can play is this 10.5 is equipment, and I have an invoice for that for 9,500. I can't play a game there. But I've got $1,000 worth of soft costs, installation. Legally, it's part of getting this thing going, and I have to have it there. But as we'll see, if I can deduct it, I get the tax savings immediately. So maybe I want to get my electrician not to put installing this network router on the invoice, but repairing something else. That way he gets $1,000, and I get to deduct it. So the only game I can play is in terms of the soft costs and misrepresenting that tax evasion. But legally, I take the installation cost, add it to that, and I spread those out. Okay. So essentially, I now have a series of tax savings. Take 0.5 times this, going forward a very long time, because a declining balance never gets to zero. It's a penny, very, very long time. So I've got a series of tax savings that look like this over time, and we'll value those a little later on. Okay. So how do we do things in Canada? Well, we have a set of rules which are called capital cost allowance, and all I've done is summarize many pages in the Tax Act for you here with the relevant aspects of the Act with respect to engineering. Now, most of our examples are much simpler than this, and this is what you need to refer to when you have special cases. Most of the time, we have a normal analysis, where what normal means is, one, there's no government incentive program, so there's no tax saving benefit programs that incentive programs I'm going to use. And secondly, we're making money. Okay. If I'm making money, in other words, paying taxes, then tax savings have a value, because this is tax savings. Don't pay any taxes, we can't save taxes. Therefore, depreciation, as we see, has no value. So these are definitely tax savings. I've got to be profitable. And secondly, I need to adjust my normal course of affairs if I'm taking investment tax credits as part of my project analysis. If those situations, if you're coming across a project like that, you've got to follow these rules. The basic rule for normal projects, where normal means no government assistance and I'm making money, the biggest difference between declining balance and what we do in Canada is this half-year rule. The half-year rule says, in year one, you're only allowed to take half the value of the asset. So if I go back to here we took the entire 10,500 to calculate this. But Canada says, no, no, no. Half of this times 30%. That's the half-year rule. So this number is half of 3150. And then from there, it's totally normal. 30% of the declining balance in a normal manner. Now, there's the stated reason for doing this, and there's the not stated reason for doing this. The stated reason for doing this is, think about companies, and in the first year, on average, how long do they own the asset? Well, some of them buy it in January and own it for 12 months. Some buy it in December and own it for 1 month. What's the average? 6 months. What's half? 6 months, half a year. Stated reason for this rule. What is the real reason? Soft cost? No. Think about government revenue. Here, the tax savings is half of this, or $1,500. That is lost revenue to the government. What about if I have the half-year rule? Well, they're not losing $1,500, but only $750. So the government, once they introduced this, they quickly determined that they were losing far too much revenue early on. And they said, let's slow it down. But we're not going to tell people that we're slowing it down because we want the money. We're telling them that we're slowing it down because on average people have this machine for 6 months in the first year. But the effect is that this number is half, therefore the tax savings is half, which means the government in the first year doesn't lose that much money. Okay? So that's the reason for the half-year rule. Okay? And so what I'd like to do next day is talk a little bit about the standard way of handling a project according to these rules. Okay? And then as we go throughout some different examples, we'll work in what happens when you're not making money and what happens when you use government tax credits. But by and large, the normal project analysis, you'll get no government subsidy and you're making money. Okay? Have a great weekend.